Good morning, all of you. Once again, I welcome you all back. So, today our video is upon the financial ratios. Like, we will continue from the previous ratios, whatever we have discussed, that is liquidity ratio, current ratio. So, we will discuss different types of ratios. Okay, and my name is Priyanka Mahanta, Assistant Professor of Business Administration Department, USTM. So, let's begin our today's video. So first of all, let's see what are the topics. Okay. So after knowing the liquidity ratio, that is the current ratio, okay, and quick ratio, now another type of ratio is profitability ratio. Now under profitability ratio, we have different types of ratios under this. Like for current ratio, we had for liquidity ratio, we had two ratios, right? That is, one is current asset, one is current ratio, another one is quick ratio. Now similarly, for profitability ratios also, under profitability ratios there are different classification of ratios. So we will look into it one by one. So here it's written that a firm's profitability can be assessed relative to sales, assets, equity or share value. The profitability ratios are important because they indicate whether the firm is doing what is set out to do, make a profit and provide a return to its investor. There are many measures of profitability. Each relates the return of the firm with regards to the sale, asset, equity or share value. As a group, these measures enable to evaluate the firm's earning. The criteria for earning can be related to a given level of sale, a certain level of asset, the owner's investment or share value. So, earning results in profit. Without profit, a firm can be handicapped to attract outside capital. The income statement of the firm shows the total profit earned by the firm during the preceding financial or fiscal period. Now, when we talk about profitability, it means the profit. Okay, profit is really important for every business concern. Okay, whenever they are earning profit, it is a kind of we can say some kind of energy or fuel, okay, fuel to the company, because without any kind of profit they cannot attract outside source of fund. Okay, if for example me being investor, if I see that this particular company is not earning any kind of profit, then why do I need to invest there? Because I'm not going to get anything out of it. So before investing into the company, we all see the uh, profitability of the company, like what is the profit ratio of the company, whether they are earning enough to pay or return to their shareholders or not. Okay, that return to the shareholders is the main thing. How much they are earning, how much sales they are doing, okay, how much asset value do they have, or how much is their share value in the market. This everything matters towards the profitability of the business. Fine. So me being investor, we definitely need to see whether the firm is earning profit or not, how is the financial condition of the company in the past few years, how is their performance based on profit. Okay, so depending upon these things we can judge the profitability of the company, and we can take some decisions that whether we need to invest or not. Fine. So without profit, sorry, without profit the firm is kind of handicapped. Okay, they cannot take sources of fund from outside because no one will be willing to invest in it. Fine. Now let us see the formula for and what are the different types of ratios under the profitability ratio. So here you can see that the important ratios which highlight the profitability of a firm would be as follows. Earning results in profit. So without profit, a firm may be handicapped to attract outside capital. The financial statement of a firm shows the total profit earned by the firm during the preceding fiscal period. This we have already discussed. Now you can say the first ratio that comes under profitability ratio is the gross profit ratio. Okay, now you should know what is gross profit and what is net profit. Fine. Now gross profit, whenever you calculate gross profit uh, while making the trading and profit and loss account, okay, so gross profit means your main income is what? Your main income is sales, right? From sales, okay, from your revenue, all the direct expenses are deducted first. Okay, direct expenses can be the purchase of raw material, okay, the carriage part, okay, the wages that you have paid to the labor. Okay, so this comes under the direct expenses. Okay, so from revenue, when direct expenses are deducted, you are left out with the gross profit of the company. It is gross. Okay, now from that leftover gross, when you are going to deduct all the indirect expenses, here you may have numerous and numbers of indirect expenses, starting from the rent to the electricity part. Okay, then maybe some telephonic charge, telephonic bill, okay, maybe some stationery bill, maybe some interest that you have to pay, maybe there is a that the salary that you pay. Okay, there is a difference between salary and wage, please don't get confused with that. So again, there can be like the electricity bill, okay, stationery bill, advertisement cost. These things are your indirect expenses. Okay, so from that gross amount, when you deduct all your indirect expenses, and you have to definitely add up your indirect income in the sense like some interest you have received from some kind of investment. Okay, so this kinds of, and some discount you have got from your supplier. Okay, this you can add it up, and finally after subtracting the expenses and adding up the indirect income, finally whatever amount is left over, that is the main or the net profit of the company. Okay, so here to find out the gross profit ratio, it measures the percentage of each value remaining after the firm has paid for its good. The higher the gross profit margin, the better and lower the relative cost of merchandise sold. Thus, it serves an important tool in shaping the pricing policy of the company. So what is the formula? Gross profit equal to gross profit divided by sales into 100. Okay, so where gross profit means sales minus cost of goods sold. Okay, and net sales means from cash sale you have to of cash sale plus you have to add up the credit sale. Okay, and if there is any sales return, then you have to minus it. Fine. So like this, our gross profit ratio should be higher. Okay, if we have higher gross profit margin, that means it is better. Okay, it is better for the company. Next one is net profit ratio. So what is net profit ratio? I already discussed with you what is net profit, right? Like whatever is remained from there, you have to subtract all the indirect expenses and you will be having the net profit of the company. So it is also called as net profit margin. It measures the percentage of each sales in rupees after all expenses including taxes has been deducted. So this is what I told you. Okay, like net profit after tax, after paying the tax. Okay, when you're paying the electricity bill, when you're paying the like stationery bill, when you are paying the advertisement bill, postage charges, telephone charges, fuel charges, salary, etc. Along with that you have to pay the tax also, right? So after paying the tax, whatever amount is left out, that is your net profit for the company for that particular here. Okay, so here we are going to see the relation between the net profit along with the net sales of the company. So a higher profit, higher ratio speaks about overall efficiency of the business. So it also focuses the attention of the better utilization of total resources. A lower ratio would mean a poor financial planning and low efficiency. So a net profit margin of 1% or less would be unusual for a grocery store, which a net profit margin of 10% would be low for a retail store. So it is divided by net income by sales. So depending upon the business type, this percentage may differ. Okay, but we have to make sure that our this net profit margin is higher. Okay, so the formula for net profit is net profit after tax, okay, divided by net sales into 100. Moving on to the next one. Now next type of ratio is activity ratio. Now what we mean by activity ratio, see, these are used to measure the speed with which various accounts are converted into sales or cash. Okay, you have to see how fast, okay, within how much of time, suppose your stock get converted into cash. Okay, you have made the products, you have the finished goods, but you should know now that this much of finished goods will get converted into cash within what period of time. Okay, if you don't know that, then ऐसे ही बनते रहेगा and the stocks will just get up full and you will have no money left out with you. So we have to see that how much of like what is the speed of the turnover. Okay, once the goods is ready, how much time it takes to get converted into cash. So here these are used to measure the speed with which various accounts are converted into sales or cash. If measures of liquidity are generally inadequate due to the composition of the firm's current asset and current liability. So what are the different types of turnover ratio? See, activity ratio is also known as turnover ratio. Okay, so what are the different ratios under activity ratio? It's stock turnover ratio, debtors turnover ratio, and creditors turnover ratio. Okay, now let's move on one by one, the stock, debtor, and creditor. So stock turnover ratio, this is the example that I gave you now. Okay, the finished goods you have in the godown, but how much time will it take to get converted into cash? Okay, so it is commonly measured the activity or liquidity of the firm stock. The stock turnover ratio is also known as stock velocity. Okay, velocity means what's the speed with which an object travels. Okay, so here it is the speed on converting the stock into sales then to cash. So here we are trying to measure the speed. I have the finished good, then I have to make the sales fast, then after sales I have to convert it into cash. Okay, this is the cycle. So it indicates the number of times the stock have been turned over as cash during a given period of time. Okay, so you have to see how many times the stocks are being converted into cash. Okay, how many times this if it's more, it's good, that means your sales will go up. If it's less, then it's kind of tension situation, that means your stocks are not converted into sales and cash soon, or we can say it takes some time. Okay, so this indicates the number of times the stock has been turned over cash during a given period of time. So it evaluates the efficiency with which a firm is able to manage its stock. We have to see that the company is how well it is to manage the stock. Okay, how they're managing the stock. So if cost of goods sold is known, thus if we know how much is the cost of goods sold, then the stock turnover can be calculated as, this is the formula. So stock turnover ratio equal to COGS, that is cost of goods sold, divided by average stock at cost. Okay. Now, how do we calculate the COGS? COGS is calculated if it is not given to you directly in the question. Then if COGS is not given, then to find out COGS, the formula is net sales minus gross profit. Okay. Now, how do you calculate the average stock? Average stock means opening stock will be given to you. From opening, you just add the closing stock and then divide it by 2. Okay. Then again, if COGS is not known, it can be computed as, this is if no information is given about COGS, if net sales is not given, or sorry, if gross profit is not given, then what we can do is, the formula is net sales divided by stock. Okay. Next one is debtors turnover ratio. So it is also known as debtors validity. Okay, the birth of debtor comes from credit sale. Okay, total debtor include the bills receivable also. The bills receivable are written promise of trade debtor. Trade debtor are normally provided with 3 months of credit time. After the expiry, they will pay cash. Thus, debtors are expected to be converted into cash within a short period of time. Now, when a company is providing some kind of credit, okay, suppose you have sold goods to the buyer and he has taken goods from you on credit. Now you will give him a certain time period, right? It's not that he can return anytime whenever he feels like. Okay, so there is a credit policy of every company. So suppose they have to pay within 3 months. So after 3 months the debtor has to pay the money. So you have to make sure that this time period is low as far as possible. Okay, how we can do is that we have to we have to motivate the debtors to pay us the money as soon as possible. What companies does is they provide certain kind of discount. They says that okay, I'm giving you 3 months of credit, okay, period, but if you pay me within 2 months, I'm going to give you 1% or 2% of discount on the amount. So it's a good opportunity, right? That means you are getting your money faster. The company needs to always focus that they can get converted their products into sales, then into cash as fast as possible. Because if there is a long gap between the sales and the cash receivable, then it will create some working capital problem in the company. So we don't want that, right? So whenever you are providing some kind of credit period to the debtors, you have to make sure that the money is converted into cash within short period of time, and for that the company can give certain kind of discounts as well, so that to initiate, or we can say to motivate the payer to pay the money as soon as possible. Now what is the formula? The formula here is debtors including the BR divided by net credit sales, how much of credit sales you have done, okay, into number of working days. It can be 365. Okay, it depends upon the company. Now DTO indicates the velocity of debt collection of firm. Okay, so it indicates the number of times average debtor convert themselves over into cash during a year. So debtors' care should always be taken on gross value. Do not deduct the bad debt or provision for doubtful debt. It is expressed as the number of times. Now, see, sometimes it may happen that you may not receive your money. Okay, suppose one person has taken goods from you on credit, but he went bankrupt. Now once you went bankrupt, that means that is your, we can say that is your uh, doubtful debt. Doubtful debt means, or we can say it's your bad debt. Bad debt means you're not going to receive the money anymore because you know that he has already gone. He is bankrupt. He can't pay you anymore. Okay, so for dealing with such situation, the company should always keep certain kind of provision. Okay, so that whenever such situation arises, the company should not fall into any kind of difficulties. Okay, so that's why whenever they are preparing the financial statements, they always try to keep some money, say for doubtful debt or bad debts. Okay, so when we see from the point of view of a company, we can say that the money, the debt, this one, DTO, debtors turnover ratio, the higher it is good. Okay, because that means they are collecting the money from the debtors at a great speed. They are not keeping much time lag between the sales and the payment, so it will not affect their working capital requirement. Okay, because if they are providing on credit, the goods has gone. Okay, but now to make the goods again, to produce the goods again, they definitely need certain kind of money there, right? To produce the goods they need money, so from where they will get the money? Ultimately the sales that they have done from there only, no? But if they are not receiving from that, that means again they have to borrow money from some other sources. So when they're borrowing money again, that means cost is involved. Cost in the sense, no one is going to give you money free of cost. You have to bear certain kind of interest in it. Okay, so you have to see that how fast you can collect it, so that the company can survive in a better way without any kind of other urgencies for funds. Fine. Moving on to the next one, that is creditors turnover ratio. Okay, now what is creditors turnover ratio? See, creditors come into being out of credit purchase. Creditors include both trade creditors and bills payable. It is included in the current liability since the payment has to be made within 3 months normally. Okay. Now we have talked about debtors turnover ratio. Debtors turnover ratio means from the point of view of a company, someone else has taken purchased from us on credit. Okay. But now when we are talking about creditors turnover ratio, that means me as a business, I have purchased something from the other person on credit. Maybe suppose I have purchased raw material from the supplier on credit. Okay. Now अभी मैंने भी लिया है. They will also give me a time period that within 2 months or within 3 months you have to pay the amount. Fine. Now, me being a businessman, at this point of time, my money will go out, right? Because I have to pay now. I'm not going to receive, I'm going to pay. So whenever I'm going to pay, that means my money will flow out of the business. So we have to make sure that the longer the time we get to pay the money is better for the company, is better for us. Okay. So when we are talking about this credit purchase, we have purchased something on credit and we have to pay the money. So the longer the time period in this case is better for us, so that the money will stay in the business itself and we will be able to utilize the money. Okay, and we will not be in need of other sources of funds over here. Okay, so the formula for creditors turnover ratio is creditors plus bills payable. Now here we are talking about payable, that means I need to pay. That's why bills payable. But in the debtors turnover ratio, it was bills receivable, because debtors means I was going to receive money from them. Okay, so receivable. So you have to remember these terms carefully. Debtors means you're going to receive, creditors means you're going to pay. Fine. So creditors plus whatever bills payable we have divided by the credit purchase into 100. Okay, now credit purchase means whatever purchases you have done, from that you have to deduct the cash purchase. Suppose you have purchased for 5 lakh rupees, out of that you have paid already 2 lakhs, then remaining is how much that you have taken on credit. It's 3 lakh rupees. So the credit purchase will be 3 lakh. Okay, so in this case the creditors turnover ratio, we can say the lower the ratio it is good for us. But in case of debtors turnover ratio, the higher the rate is good for us. Higher in the sense for debtor means that my money is getting converted really soon. I'm getting all the money that I have invested in it. Okay, but in case of creditors turnover ratio, it should be lower so that the money stays in the business for me. And if they give me longer period of time for credit payment, it's well and good for me, because I may not require any other sources of funds over there. Okay, so these are the ratios till now that we have discussed. So we already discussed about the what to say, liquidity ratio. Okay, that is current ratio and quick ratio. Then we have discussed about profitability ratio. Okay, so under profit, when we talk about profit, there are two types of profit: gross profit and net profit. And finally the activity ratio we have done. So activity ratio is also known as the we can say turnover ratio. Okay, turnover means how fast you are converting. Okay, the speed, how speed how speedily you are converting your stock into cash, how speedily you are converting your debtors into cash. Okay, like that. So under activity ratio we had stock turnover ratio, we have debtors turnover ratio, we also had creditors turnover ratio. So this is the complete thing that we need to study in this video. So in the next video, or in the coming video, we are going to discuss the remaining ratios that is there. Okay, we also have solvency ratios and all. So there are more ratios that are to be covered in the coming videos. So thank you so much for this video. We are ending the video over here. Thank you.